Right, some breaking news coming in. Following the IndusInd Bank fiasco, sources have told us that RBI supervisors are seeking details on positions on derivatives across banks. Is that right, Vishwanath Nair? First, explain to us who are these supervisors who are seeking information, and what is the implication of this news?
Most large banks across the country have somebody called an SSM, who's a senior supervisory manager, who's an RBI agent who looks at the banks closely. Now, these supervisory agents are responsible for day-to-day supervision of how banks are functioning and whether things are going according to the rules that have been settled here. What we are understanding from sources is that these SSMs are asking banks to submit specific compliance reports. Every quarter, they're supposed to submit a compliance report already, but specific compliance reports on where their foreign currency borrowings are, how much of that has been converted, what portion of that has been properly hedged, what portion of that is currently in mark-to-market losses or profits, all of these details, and whether all of this is in order with the existing regulatory framework, the RBI seems to be asking these banks. That is what our sources are telling us. Now, this is obviously coming on the back of what has happened at IndusInd Bank, where the bank said that there were certain positions on its bank which it discovered only in October, and that's why it's going to make certain provisions during Q4. 1,520 odd crore pre-tax or adjusted for tax. That's what the management is saying. The market estimates close to 2,000 odd crore. So we need to see whether other banks also fall under such open positions, such gaps on their derivatives portfolio, and if they do, then what kind of provisions they will be required to provide. My sources are telling me, however, that most banks are not in such a situation. In fact, they are very clear how exactly they are going to hedge their positions, and the quality of the hedge is perfect to address any market shortfall. Of course, there will be M2M losses when the rupee depreciates to a certain extent, but a 2,000 crore loss is significantly large and most likely is limited to IndusInd Bank.
Okay. Wow. So, just to get a sense of, is the derivatives portfolio that significant for any of the large listed players that we know of?
It is. So IndusInd Bank alone ran a derivatives portfolio with a notional value of 15 lakh crore, right? And IndusInd Bank is probably number 5 in the private sector banking space. So you can expect most banks have a large derivative position. Having said that, highly unlikely that most banks are sitting on these massive losses, which may affect their quarterly reports.
Most specifically, massive losses that they did not know about, and they have suddenly discovered.
So that one's a bouncer, actually, because I was talking to a senior banker at a private sector bank, a bank much larger than IndusInd Bank, and they were saying that the rules have not changed. Firstly, the RBI has not outlawed any specific kind of a transaction, so they are not sure what clarifications IndusInd Bank is providing. Having said that, even if there was a loss, the minute you find the loss, a loss is a loss. So you account for it and you move on. And if you found that in October, then the December quarter results should have accounted for that loss. Why has this been pushed to March? Anybody's guess at this point in time.
Okay. Lots of questions there on IndusInd Bank and more. We're going to be following the story, and a lot more coming in on that. Thanks for that for now, Vishy.